Hello, everyone. Happy Fed Day. It's Wednesday, September 21st. We're going to be talking to Sam Stovall from CFRA Research, trying to make sense of this market, chopping all over, going up, going down, finishing net negative for the day. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny and very smoky Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets the best we can using the language of technical analysis. I was talking with Pat Dunwilla, who runs the chart report earlier today over at All Star Charts, and we were talking about some of the challenges and the real benefits of using technical analysis in this sort of environment. And I will tell you the benefits far outweigh any shortcomings of the technical toolkit. It's designed to help you interpret the messages providing back to you in the language of technical analysis. Let's continue on here with the schedule. I'm really excited to talk to Sam Stovall from CFRA Research. I like bringing in some really thoughtful macro strategists on Fed Week, and Sam is one of the best. Next week, three pretty positive guests to share with you as well. On Tuesday, the 27th, we have Mark Chaikin of Chaikin Analytics. On Wednesday, the 28th, Miss Schneider of Market Gauge. And then on Thursday, the 29th, Greg Schnell from Osprey Strategic. We also have a pretty significant event coming up in early October. October 7th and 8th is ChartCon 2022. You can go to stockcharts.com/ChartCon for more information on this fantastic event. I was chatting earlier this morning with our four guest strategists who will be doing the sector deep dives. We have Julius DeKempener, who's going to talk about sector rotation, uses RRG methodology to show how the sectors tend to rotate from risk on to risk off. And then we have three guest strategists, each diving deep into a particular sector. Joe Rabel is going to dig into the technology sector. Greg Schnell is going to break down energy, and Bruce Frazier is going to break down the industrial sector. It's a great opportunity to see three really knowledgeable market experts deep dive into one particular sector, share with you what they like, what they don't, what's working, what isn't, and how they go through their process of analyzing stocks and sectors. Go to stockcharts.com/ChartCon to sign up for that event today. Let's continue on today's show with our market recap. Fed Day is always an interesting one. A couple of things that have tended to happen around Fed Day, and most importantly, a lot of volatility. And if you like volatility, you like Fed announcement days. And let's look at the chart and see what actually played out today. The hour or so after the Fed announcement at 2 o'clock was choppy, right? And the initial reaction going from up about 1% to down about 1% or so. I'm sort of rounding a little bit. Then during the press conference, we spiked right back to the upside briefly, and I can't help but notice right to 3,900, which is someone commented on our YouTube video yesterday. How many times did Dave say 3,900 in an episode? And I think the answer is like 8 or 9. So sorry for that, but again, we did happen to hit right at that level today. So it clearly has meaning. But what happened soon after was we rolled over, and I think the messaging that a lot of people sort of gravitated to going into the close is that message that rates are going up a lot, and we're not done yet, right? And projections I've seen are going, 4.5%, 5% now. I'm hearing thrown around on Bloomberg. They're talking about Nouriel Roubini coming up with a 30 to 40% drop further in stocks before all is said and done. So a lot of negativity all of a sudden, and that's certainly being expressed in the market rotating from 3,900 to 3,800 in the course of about an hour. But as always on the show, let's look at what happened today and then try to connect it to the big picture. I think that's what's most important. So for today, the S&P down 1.7%, just below 3,800. The NASDAQ about the same, all sort of similar amounts to the downside. Mid caps and small caps down as well, not nearly as much. The VIX pushing to the upside, which usually happens when you have a choppy day, net negative. The VIX is going to go higher. Now back above 28, not quite to that 30 level, which has been a key level we've talked about many times, but getting closer, I feel like, every day. Interest rates had pushed higher going into that 2 o'clock hour Eastern, rotating back to the downside. So rates actually came off going into the close, with the 10-year yield still around 3.5%. Now, when the Fed changes rates, they're changing essentially the short end of the curve, which is fluctuating based on their target rate. But obviously, it affects certainly the rest of the curve as well. So overall, 3.5% still pretty high relative to the recent history. But if you look over at the long-term history, 3.5% is still on average pretty low relative to where rates have been. The dollar index, by the way, moving higher by a full 1% using the UUP. If you missed my conversation yesterday with Samantha LeDuc, it was a really good one, and we focused on interest rates and the dollar. You can find that episode along with all of our others at StockChartsTV.com. Gold and silver both higher today. Gold is sort of the classic inflation hedge. Hasn't really done a great job of that in 2022 because the strong dollar has made it pretty tough for gold to perform well. However, GLD moving higher by about 0.5%. Silver prices up almost 2%. Oil prices down a bit today. Finally, cryptocurrencies, quite a mixed bag and a lot of choppiness in equities, but even more so in the crypto space. We had Ether that bounced around quite a bit, got up to 1380, but currently right around 1320. Bitcoin dipping back below 19,000 here as we're going live after 4 p.m. Eastern. That's after spiking up to almost 20,000 earlier this afternoon. Now, let us take a step back here and briefly look at the chart of the S&P 500. This is the daily chart that we refer to pretty often on the show. And, it's always an interesting thing. When I was at Fidelity, we had the Fidelity chart room where we had a ton of paper charts in this big room devoted to market history through the lens of technical analysis. And we always would note when the market had moved so much that we had to reprint the paper. Because when you would go off the page to the bottom, or if you would go off to the page to the top, you'd have to rescale the entire chart and print out an entire wall. And when we would see our chart room team taking down these big papers and putting on the new ones because they had to rescale the chart, that always told us something big was happening. Either something going to a new all-time high, so you sort of had to add, paper to the top of the chart, or things were going to a new low and you basically had to bring in more data or scale the entire chart down. It feels like when I'm looking at the chart of the S&P 500, I'm often bringing in a little more data because looking at the last year, it just feels like sort of this downtrend over the last 6 to 8 months. And bringing in a little more data, you bring in, earlier in 2021, in 2020, so you can understand where we're at relative to that big picture. If you don't want to do that, obviously look at weekly charts, right? Look at longer term charts, look at monthly charts to think about where we're at in that longer term cycle, and then focus on the weekly and the daily data to understand how the current movement sort of fits into that bigger picture. As of today's close, we rotated below 3,800, and that takes us below a really important Fibonacci level. 3815, 3820, depending on how you measure it, is about a 38.2% retracement if you go from March 2020's low to January 2022's high. This dotted line here in purple is right above 3,800. That's a 38.2% retracement. That was the intraday low in May. That was a level we toyed around with a lot in June and July, eventually rotated higher. And now we're once again, we have that level in play. If you step back from your monitor a couple steps, you could argue as long as we remain sort of in this level, years from now, we might see this as being just a beautiful Fibonacci retracement. And now we're just in this bottoming process. But I'll tell you, day to day, it doesn't feel like that. It feels like we're breaking key levels. And then you immediately have to think about further downside objectives. So what would happen if we continue to push lower through the course of this week? Well, the immediate attention, I think, would be at the June low. It's around 36.35, 36.40. We break that, then I would have a downside target well prepared, because if that level is broken, which is not too far from where we're at now, that's 130 points below current levels, 140 points. We break that, you have to start thinking about further downside objectives, 3,500, 3,200. What could it be? And I would have a good answer for that question. The objective we've been talking about is 3,200. That's a 61.8% retracement of March 2020 to January 2022. Let's go back to the dashboard and just see, regroup on what happened today. Sort of a risk-off move, certainly going into the close. And you can see the sectors in general at the top are a little more defensive. We have consumer staples still negative, but the best out of the 11 sectors today. Industrials was number 2, actually, down 1.3%, followed by utilities, energy, and real estate. On the downside, what really pushed the market's lower. Communication services, which has certainly been one of the worst sectors year to date. Consumer discretionary after that, the XOY. And the XOY has actually been surprisingly strong given the general defensive feel to the market at times in 2022. Impressive to see some of the strength in the consumer discretionary space. Look at what happened today in some of the market movers. And again, if you use StockCharts, which we certainly hope you do, I would encourage you as a member to set up your dashboard to really make the system sing for you, right? To help you answer the questions you're trying to answer. The gear icon in the upper right corner of your dashboard is where you can add some of these things. If my dashboard looks a little bit different than yours, it's because I've customized this a great deal. So what worked today, right? Look at what worked on a big downtake. General Mills, GIS. Talk about a tough sector. Consumer staples has not been the best sector, but there have been some opportunities for some of these names, making a new 52-week closing high today, up almost 6%. This is an earnings name this week. It's a great reminder. You know, I was told a rising tide lifts all boats, so just pay attention to the broader market. But one thing I've certainly found in 2022 is there is a lot of room for a lot of stocks to look pretty good. And if you look at the top performing stocks today, it's a lot of consumer staples, Hormel, Conagra Foods, Kraft Heinz, Campbell's, all in the top 10, and Kellogg was number 2. The other thing I can't help but notice, renewable energy equipment. This is something like Enphase, which is our top ranked stock in our scooter large cap rankings. That's solar stocks and other names in there as well. The best performing group, up 1.5% today. Let's take a quick commercial break. We'll be back with Sam Stovall from CFRA Research. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. Thanks so much for joining us every weekday after the close for our show. We're going to bring on Sam Stovall from CFRA Research here in a moment, but a couple quick announcements before we do. First off, we'll do a mailbag segment on Friday's show this week. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer one of your questions live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. I was talking earlier today with four of our upcoming experts for ChartCon: Greg Schnell, Joe Rabel, Julius DeKempener, Bruce Frazier. All 4 of them do a weekly show on StockCharts TV that is just filled with insights and expertise and ideas of how to approach this market. All of our shows can be seen at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Sam Stovall. Sam is the chief strategist at CFRA Research, coming to us from Eastern PA. Sam, it's great to see you. Welcome back to the show.
Hey, Dave. Good to talk to you. Glad you're feeling better.
Thank you so much, and I appreciate you coming on today. Fed Day, so obviously a lot of attention on Powell's comments and the 75 basis point rate hike. You always do such a great job of helping us sort of take a step back and digest what happened and think about the major themes. What stands out to you when you're looking at the markets today?
Well, I think what stands out is how the market seems to be slicing through many of the different Fibonacci or other support levels, and it's now headed for a retest of the June 16th low. And the big question is, how high will the Fed need to go and for how long in order to fight inflation? And that's the real question right now. And the question then is the June 16th low going to be the low for this bear market? And at least for right now, I believe it will.
It's very, very interesting. Now, when you see when you hear the comments from Powell about 75 basis points, but no necessary end in sight. When you're thinking about the evidence that you're gathering around you as an investor, what does that help you, or what does that cause you to think about between now and year end? Where should we be headed, or where may we be headed, given what you learned today?
Well, what I learned is that, volatility is probably not going to be on the sidelines for a while. That if you think September is bad, just wait till October, because October historically is 36% more volatile than the average for the other 11 months. Also, what I have found, this being a sophomore slump year or the midterm election year, that usually we end up with a market low sometime in late September or into early October. So the market is really playing out the way it traditionally has. I think the question that a lot of investors are doing is they are projecting recency and assuming that as we head into 2023, the market investors will not be looking across the valley and trying to find some sunlight appearing through these dark clouds.
Yeah, it's a great point. And I know, Sam, you're involved with an ETF that's really designed to capture that seasonal, that seasonality and some of the sector leadership. Can you tell us a little bit about what that calendar, sort of the normal calendar, would cause us or should cause us to expect going into September, then October and November, right? When things I think usually start to shift.
Sure. Well, I wrote a book a few years called The Seven Rules of Wall Street, which are essentially old rules of thumb that still work that allow you to outperform the market using sector rotation. One of them being the obvious sell in May and go away. But I say rotate, don't retreat. Gravitate toward the defensive areas May through October, but then lean cyclically November through April. So this would match up quite nicely with the presidential cycle because basically we have seen the market down about 3.5% in the May through October period of midterm election years, whereas by being defensive, you can keep your head above water. However, once you get into that end of October timeframe, especially when you're dealing with the midterm election year from October 31 of the midterm election year through October 31 of the year after, the market posted a positive total return averaging 21% and has never declined since World War II. That's obviously not a guarantee, but it does offer encouragement that maybe we end up seeing that kind of a move again going forward.
I feel like if your runway is long enough, the long-term returns tend to get a little more attractive, right? The problem are those career-busting moves that can happen along the way sometimes. I did want to get to your charts because you had a really interesting chart, really focusing on breadth using S&P sub-industries. Can you talk us through what this is suggesting?
Sure. There are nearly 150 sub-industries in the S&P 1500. That's their large cap 500, mid cap 400, small cap 600. By evaluating the week ending rolling 10-week average, and then also looking at the rolling 40-week, so this is basically a 50-day and a 200-day moving average. On June 16th, we were at 0%. None of those sub-industries were above their 50-day or 10-week moving average, and only 7% were above their 40-week. Well, going back to inception for this index back in 1995, we basically that whenever we had a low that emulated that, we never went lower. So we closed recently at 9% on the 10-week and then 14% on the 40-week. So we're still staying slightly above those June 16th lows. So as you said before, if we do break below that June 16th low, then we've got to reevaluate where we see the market 6 to 12 months from now.
It's such a great analysis, and I thank you so much for sharing that, Sam. We only have about a minute left, but I did want to just ask about one more question about interest rates, if I could. We've heard a lot of different objectives for where the 10-year could end up, and I know there's a lot of question marks. Certainly, we've seen the effect of higher rates and how it's affected growth stocks in particular. Do you have a target of where you would expect the 10-year to go? And if not, what are you looking for, and how should we be interpreting this as an individual investor?
Sure. Well, the real worry is the inverted yield curve. Anytime that CPI on a year-over-year basis exceeded 6.5% since World War II, we ended up in recession with a bear market. But as the Fed is getting aggressive on the short end and we are seeing the inverted yield curve widen, that basically implies a very sharp slowdown in the economy. So we don't see the 10-year going above 3.7% because it'll start to come down as the bond market starts to expect a recession around the corner.
Sam, I often wish we could talk for hours because you have such great expertise and you share so willingly of your of that expertise, but we'll have to wait for next time. Thanks so much for joining us and stay safe there, okay?
Thank you, Dave. You too.
That's Sam Stovall. Sam's the chief investment strategist at CFRA Research, coming to us from Eastern Pennsylvania. I mean, just what a great wealth of expertise that he has to share. And he mentioned a number of things I wish we could go into more detail on, but a couple things that stand out to me as we're talking to Sam's sharing some thoughts. Number one, he mentioned his book, which is well recommended, and I think very justifiably so, on sector rotation. He literally wrote the book on sector rotation and thinking about that seasonality and the cyclicality of stock and sector leadership. So a lot of the visualizations, a lot of the analytics we designed on sectors were really inspired by Sam's work, thinking about leadership in different phases of the cycle. The second part of that is just thinking about interest rates, right, and thinking about the 10-year, and not just the level of the 10-year, but the shape of the yield curve. The chart I was just showing there a moment ago. My chart of the 10-year has value over growth, because I think that often it certainly lines up in general with the direction of the 10-year. You can see when rates are going higher, value stocks have tended to do a little bit better, and that certainly played out in 2022. But at the bottom, it's doing the 2s versus 10s. It's looking at the shape of the yield curve, and that inversion of the yield curve, as he mentioned, has certainly been a part of the recessionary stories that we've seen in previous decades. So worth focusing on the message of rates, message of the bond markets, thinking about how that can impact some of the stocks that you're invested in. Great take there, as always, from Sam Stovall. Let's continue on with our next segment. Don't fight the Fed. What we like to do on a Fed day is just take a step back and analyze some of the trends and signals to pay attention to. Sam and I think talked on some of the key themes to pay attention to. So I'll just highlight one or two more, and then maybe just get into some of the individual stocks and how they traded around the Fed meeting today. When we talk about the big picture, my conversation yesterday with Samantha LeDuc was focused a lot on the dollar. And the dollar has been called, she called it the release valve for the markets. I've described it as the wrecking ball for risk assets. And there are others that other adjectives or ways I've seen metaphors that are inspired by the dollar. But the fact remains that when you look at 2022, there is a relative small number of things that have had consistent uptrends. And the dollar index is probably the most obvious of those. At times it was energy stocks, right? And others that have had really good stretches. But in terms of year-to-date performance and consistent strength, the US dollar is certainly one of the better charts out there. And what strikes me about the chart of the dollar is not just that the trend has been up, which is higher highs and higher lows. That's what Charles Dow taught us what a trend line is. But look at the momentum, right? Look at how when the dollar has moved higher, it's tended to become overbought. Look at when the dollar pulls back, often to its 50-day moving average, the RSI has rarely gotten below 40. And that whole idea is something that I first learned from reading Connie Brown's book on technical analysis. Andrew Cardwell did a great job of popularizing that methodology as well. And it's the whole idea that the range of a momentum indicator or an oscillator can fluctuate given the larger trend. And that's one of the great uses I have found for RSI, is not just for picking short-term peaks and valleys, but just recognizing the overall larger level trend. As long as this pattern continues, which it certainly has through this week, suggests that overall the trend in the dollar is strong. And how well can risk assets do when the dollar keeps pushing higher and higher like that? And I would assume that the answer to that is not great, because that as I mentioned, sort of the wrecking ball for risk assets. Let's look at some other charts. We mentioned the FANG stocks, or what I tend to call the phenomena stocks, those 8 sort of mega cap tech consumer communications names and what they've done. And again, I have found that analyzing the broader equity markets is not just about analyzing the broader indexes. It's looking at the stocks and sectors and groups that comprise those indexes. That's why market breadth is so important to me in my process. That's why I love when a guest like Sam Stovall talks about breadth and thinks about what that tells you about broader market participation. Let's look at some individual stocks and what they are doing this week. A bull market phase, I have found, you find a lot of charts like this. You find General Mills types of names that are just hitting resistance at 78 and then powering through them to the upside. Enphase might be another example of that type of stock here in the last couple of weeks. Hit a key resistance level, pushes above it. The problem is not a lot of stocks look like that right now, right? A bear market phase is marked by stocks attempting to get above resistance, but failing to do so. So when I see Netflix rallying beautifully off the May low, a little bit of a higher low in June and then rotating higher. That's encouraging in mid-July when we break above 200. What is not encouraging is when we hit resistance at 250 and then we hit it again and we don't make it above there. Now, this might not be done. Tomorrow we could rip to the upside, and that is certainly still an open question. But I am like a hawk watching charts like Netflix to see if 250 can be eclipsed, because this market has a chance to move higher if stocks like Netflix are able to make new swing highs, right? That's what demonstrates that buyers are around, right? People are putting cash to work. When that struggles to happen, that's when I think the market is struggling as well. WYNN is a chart that we highlighted yesterday as one of our 3 and 3 charts. Might have been the day before that. It's a bit of a blur, but on this chart, 70 is probably the example, right? That's the resistance from early June. That's the resistance in August. It's the neckline of an inverted head and shoulders pattern, which is a low surrounded by 2 higher lows. And the trigger on that price pattern is a neckline connecting the interim highs, connect the June high to the August high. We traded right above that yesterday, but closed back below it, and then further deterioration today. Charts like WYNN getting above resistance, that would be encouraging. Not happened yet. Other things I would look at, Amazon, not just pulling back from resistance, but breaking below the 50-day moving average. We look at the number of stocks, it's less than probably 15% or so of the S&P still above their 50-day moving average at this moment. It's stocks like Amazon that have failed to hold. The last two that I'll mention to wrap up the segment, Microsoft, and making a new 52-week low today, getting below its previous swing low here on an intraday basis, but closing at the lows just below 240. That's the low that we saw back in June. So how bullish can we be if a stock like Microsoft is failing to hold support? Similar name, different sector, but similar sort of look would be Home Depot. There are a lot of charts like this that made a low in June, rallied back, many of them to their 200-day, now reverting back to the downside. Do these stocks hold their June lows? If so, my sense of downside for the S&P would be minimal. Stocks like Home Depot and Microsoft and others fail to hold support. That is what can drive the S&P much lower to 3,500 to 3,200. That's how you get there. And names like this being unable to hold support. That's a wrap on Don't Fight the Fed, making sense of today's session from a number of different angles. We need to wrap the show and go to the 3 and 3. Let's hit 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1, looking at the S&P 500. But as I mentioned in the market recap earlier today's show, when we hit a point where I need to bring in more data because we're going potentially to a new low, that tells me when conditions are starting to get a little more painful. Zooming out a little bit, now that the S&P has undercut not just 3,900, but the Fibonacci support level of 38.15, 38.20. That's a 31.8% retracement, taking March 2020 as a low, January 2022 as a high. 21% haircut gets us to 38.15. We undercut that today for the first time. Really, we undercut it back there in June, but now closing below there for the first time since July. If we continue to deteriorate, these are the additional downside objectives using that same Fibonacci framework. 3,500 would be a 50% retracement from March 2020 to January 2022. The ultimate objective, I would suspect, is 3,200. That takes us down another, 10% to get down to those levels, actually a little further from the current. That takes us another 10% of a retracement down from the all-time highs. That would overall be about a 34% drop on absolute terms from the January 2022 peak. So downside objectives can be reached if individual stocks struggle to hold support. Now, when we talk about breadth, I thought Sam Stovall did a great job highlighting breadth using sub-industries. That was actually a really interesting chart I had not looked at before. Here we're looking at S&P 500 members. How many of them remain above key moving averages? As of today's close, only 24% of the S&P remain above their 200-day moving average. Only 16% of the S&P 500 members remain above their 50-day moving average, which means from 92% down to 16%, almost 3/4 of the S&P was above their 50-day moving average in mid-August, now back below the 50-day moving average. That is a broad rotation from risk on in mid-August to risk off today, and that's what causes me to be nervous about the potential for further downside. Having said that, can we finish the day on a positive note? We can, because I have learned in any market environment on any given day, some stock somewhere is probably breaking out and some stock somewhere is probably breaking down. Today, we highlight General Mills, not just gapping higher, but closing up on the day, making a new 52-week closing high. There are charts and there are stocks that are holding up just fine. Make sure you're using your scanning engine. Make sure you analyze the charts to focus on names that are actionable and charts that are working. Folks, that's a wrap for our show. Thanks so much for joining us every weekday after the close for the Final Bar. I want to thank Sam Stovall from CFRA Research joining us on Fed Day, helping us make sense of what we heard, and looking forward through year end. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a good night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.